Hi everyone, today we are going to discuss quarterly performance of ICICI Bank. ICICI Bank reported healthy Q2 FY19 performance with the core pre-provision operating profit increasing by 17% on a year-on-year basis. Most importantly, its asset quality significantly improved during the quarter. The slippages were contained as well as the overall stress asset loan pool declined on a sequential basis. So should we read this as a decline or end to asset quality woes for the bank? Well, the street has been optimistic on the bank's turnaround for almost 2 years. We have seen 1 or 2 quarters of good asset quality performance, which has been followed by spike in bad loans. However, this time around, we have decisively turned positive on the stock, and there are reasons for the same. So let's look at the reasons for our optimism on the bank. Our enthusiasm for the bank is not just limited to the receding asset quality. The positive readings from ICICI earnings is that despite all the asset quality issues, it has improved its liability as well as asset franchise. Over the years, the bank has diversified and de-risked its asset book significantly. Retail assets now constitutes around 57% of its total book as compared to around 37% in March 2015. During the quarter also, we saw advances growth was at 13%. However, the retail advances growth was much stronger at 21% YOY. At the same time, the performance on the liability franchise continues to be equally good. The deposit growth was around 12% on a year-on-year basis. However, the low-cost current and savings account grew by 15%. Consequently, bank's CASA deposit currently stands at around 50%, which is a very good performance on the liability side. The most important reason for our optimism on the stock is the expectations around reduction in credit cost. While the management has indicated that FY19 will be the year where we'll see much less slippages for the bank as compared to FY18, we think that the credit cost should decline from FY20 onwards. Transition to Ind AS will also help in reduction in credit cost. And last and the most important reason is that we expect the improvement in return ratios for the bank. Earlier this year, management had guided certain targets that it aims to achieve by FY20. It aims to deliver return on equity of around 15%, at the same time reducing the net NPA to around 1.5%. All this while it aims to achieve this by keeping the provision coverage ratio at around 70%. With Vision 2020 in place, we think that investors should expect the better return ratios by June 2020. And with capital adequacy, which is more than adequate, we don't see much constraints in bank delivering on its targets. So let's look at what's the outlook for the stock. With Vision 2020 in place, investors should expect much lower NPA formation, normalized credit cost, mid-teens loan growth, steady net interest margins, and the commencement of journey to achieve the return on equity of 15%. With improvement in return ratios, the current valuations with the core book trading at 1.2 times FY20 book looks very compelling. While the asset quality concerns have not completely abated, the risk reward has turned extremely favorable for ICICI Bank. With the management issues much behind us, we expect much lesser volatility for the stock and would suggest investors to buy it for the long term.